Hey everybody, I'm Marcos.
And I'm Kirsten.
And this is the Minnesota Real Estate Investing Podcast.
Join us every week as we discuss real estate investing in the land of 10,000 lakes.
Well, hello everyone. Welcome to another episode of our podcast. That is my teapot that's heating up water for my mate. Today, as you can see, I'm by myself. The reason for that is because we're leaving for Florida tomorrow at 6 a.m. is the plan. So Kirsten is going around the house and organizing everything for our trip while I take the time to do this podcast quickly in the morning. I had planned to meet with one of our investor colleagues, Ken Muck, to talk about private lending, but it didn't work out. The times didn't work out, so probably when we're back from Florida, we're going to schedule a time to do that podcast, so stay tuned for that in the next few weeks, maybe even a month, depending on when we find time to really get together. So that's why those are all the reasons why you see me today by myself. And what I'm going to talk about today is what 2023 is going to look like, or what I think 2023 is going to look like with what we have seen, the changes we have seen. We talked about, we did a market update last week talking about what was going on, the pickup that we saw on the market, that it seems that spring just started and snow hasn't even melted yet. So this is what I think is going to happen in 2023 with the Minnesota market. One of the big changes that we have just seen in the last couple months, and especially in the last month, in the last couple weeks, a few weeks to a month, is the interest rates. The projections for interest rates for spring, at the end of last year, everything was pointing towards an increase in those rates for conventional loans. Now, that didn't happen, but they went much lower than what anyone could have predicted. So there were some people that had a really positive view of what was going to happen in the spring market, but again, you have to be cautious and you have to make sure that you're not being too positive when everything has slowed down. You still have to look at comps if you want to make sure that the ARV, the after repair value of a house that you're investing in, is going to be at least somewhat accurate. And if you have to leave some money in those, well, that can happen too. Now, everything is shaping up to be another crazier year, like we said last week, and at least a crazy season. That is right now, that is today, that is February 3rd, 2023, Friday. That's what we're seeing in the market. We're seeing, like we said last week, too, houses that have been selling in multiple offers, even new houses now that came on the market, new listings that came on the market. They're selling for multiple offers. I have seen even the off-market market, if there's such thing. I talk a lot with wholesalers, and I ask them questions whenever they send me a deal, and most of those off-market deals are also getting multiple offers. So it's not only the buyer's market, the end buyer that's going to buy a house to live in, but it's also investors are trying to get everything that they can under contract and under their belt. The reason is there are various reasons for that. When we see this type of market that is getting faster with multiple offers, with more motivated buyers, what happens is that you start seeing what we saw previous years, which is an increase, a really big increase in the price of home, in the values of homes, in the appraisals, in the price that they're selling at. There may be buyers that are willing to do again, and don't quote me on this, appraisal gaps, which right now I wouldn't recommend it, but this is, like I said, today, February 3rd. There's people that are waiving inspections or certain contingencies in their contracts in order to be able to win in those multiple offers, apart from a higher price. This is gonna make it so the market sees another increase, more appreciation for your properties, which is great. However, it's gonna make it very, very challenging to invest because we still don't have the low interest rates that we used to have back a year or two ago. So that is gonna impact severely how good the numbers are gonna look, basically. And right now we are finding it challenging to make our numbers work without paying a huge down payment, which then you have to look at return on investment and cash on cash return. And again, that may not be there all that together. But talking about that, it is in our numbers, it's because we are using commercial loans. And commercial loans haven't gone down. Actually, quite the opposite. Last time I talked to my loan officer for commercial loans, they went up another half a point because they go strictly by the baseline points that the Fed is increasing. So the only way for them to stay profitable is to increase their rates. And that's just business. We could refinance it in the future. We could refinance it to a loan, to a conventional loan. But right now, we need to at least break even with the numbers that we have. And we're finding that in most so-called deals that we're finding, we're barely breaking even. Now, that is another thing that I'm going to add to all this. Interest rates are going to go down. It seems that there's going to be a very big decrease in May, at least for my sources. What they're saying is that there's going to be a very big decrease in May, and then they're going to still go down, not as much as they did in 2020, 2021, but they're still going to go to very low standards for, when you look at it historically, and especially compared to now. What this is going to create is another market where buyers can afford to compete with investors. And there's going to be a larger buyer pool for each property, which is going to make it, again, more challenging. Maybe people are not going to be as eager as previous years to go up in price, but they're definitely going to try to get that property under contract. And if they're not scared of that property at all, they probably are going to waive some contingencies, which is what we're seeing now. Contributions to buyers' closing costs, sellers' contributions or sellers' concessions, however you want to call them. It's basically the seller paying for some of your closing costs. It's something that was very common in the last 6 months. I don't want to say it's non-existent right now because you can still ask for it, but it's becoming really uncommon. So with all that being said, this is becoming a seller's market again. So good news if you're selling a property. Now be careful with the price, because it's not like in years past where you just put a price and you got multiple offers regardless of that. Right now, and what we're seeing as of the beginning of February, is that if you're overpriced, you're still gonna sit. You're not gonna sell that house as quickly or in multiple offers. We see houses that are clearly overpriced sitting still on the market without a single offer. Maybe one of our offers that are not really tempting for the seller to sell right now. There's this thing where you need to price your flips or whatever you're selling very well, and make sure that you're in that healthy medium where you're, of course, you're not pricing it too low, but you're also pricing it a little bit lower than what you should, so you can get into multiples and you can get the largest buyer pool you can. It all depends on your price point, of course. This is just a general thing and advice that I have for everyone. And even if it wasn't a seller's market, I would always advise on that, because the chances of you selling whatever property you're selling are higher when you price it a little bit lower rather than going high on it. What I see 2023 doing too, for investors is, it seems right now that whatever property that you had there that wasn't selling, if you really, do the work to sell it, it's gonna be a property that you're finally gonna be able to dispose of. And then if you're acquiring new properties, I would still be cautious. I don't like to count on a 10% increase, and then if you see comps coming at, I don't know, 400,000 right now, I would still account for 400,000 on ARV if you're doing a flip, for example, or if you're doing an appraisal, because we don't know how much higher this year is gonna go. It's still very early in the season to really see all those comps that are falling in. Maybe by mid-February we're gonna be able to see what this last few weeks have been doing as far as closings go. And of course, we're going to do an update on that. So be cautious on ARV, but don't be too cautious. Again, it's still really early. I think that if interest rates keep going down for conventional loans, we're going to get to a point where it's so cheap again to to borrow money, in perspective to what it has been the last 6 months, that people are gonna be much more willing to pay that 3, 4, 5% like they are right now. Anyone that gets close to 5 or less is gonna buy a house without any type of hesitation and probably waiving a lot of contingencies, which for the seller is great, but for buyers is not so good. And when we're investing, we're on both sides, depending on what you're doing at that point in time, of course. And you're going to have to really go over what you expect from those properties. Maybe you account for a couple of years of breaking even and just having tenants pay for the loans until you can refinance with a lower interest rate, and you can actually generate some cash flow. Then from that cash flow, depending on what you are getting for cash flow, instead of keeping it, you're gonna want to pay off the loan faster and do some velocity banking when you're doing that. The reason why I'm saying all this is to generate equity on your property, whether that is a single family, multifamily, a building. I think that the goal should be to get those assets with as low of a debt as possible. So if you're buying something and at the end you have a $300,000 debt when you refinance, the goal should be with the cash flow to start making that debt lower. That way you're saving yourself the trouble of a potential decrease in prices, which is always around the corner. I don't like to be that alarmist person that says, oh, the next crash is going to happen next month. We kind of were at the end of last year with Kirsten. I don't think that we were like that apocalyptical in our predictions. We just were predicting a correction, a little slowdown, just because we thought that the interest rates weren't going to be as low as they are right now. And those were the facts we had at the moment. Having a change like this really changes what you can do. And like I said, there are two worlds here. One is the world of conventional loans, which if you can qualify for a conventional loan and put 20% down on a house that you're going to invest in, then I would strongly advise you to do it. You can See how you can take that money out once you're done with it. What I highly recommend is the BEAR method. If you buy value add properties rather than turnkey rentals, you're gonna be much better off. Because if you're pushing equity, whether it is by adding square footage, bathrooms, bedrooms, whatever the case is, you're making it prettier. It's an old house and it needs a lot of TLC. That is going to help you increase the value of the house, which is going to help you with recovering the money that you put into the property and the money that you put to buy the property, not only for the rehab. But just be mindful and cautious. But I think that there's a lot of opportunities still out there. It's just about getting to the point where you are comfortable with investing in a certain property, whether it is for rent it out, for doing a short-term rental. I would advise, if you're doing a short-term rental, to at least have it break even when it comes to a long-term rental, and then you decide to take the risk and make it into a short-term rental. So it is really up to you and what your level of risk tolerance is and what you're willing to do. I think that counting on lower interest rates than right now is something that you should do, definitely, because that's what we're seeing that's going to happen. That is what we have changed in our buying criteria for our investment properties. If that doesn't happen, well, are you breaking even with your current loan? What is the strategy that you're using to exit that property? Does it make sense to sell it? Do you turn a profit, or at least you break even by selling it? Because sometimes that's a decision you have to make anyway. So of course, when you're buying to build a portfolio, whether it is for long-term or short-term rentals, the last thing you want to do is sell that property. But if you have to, it's better to just get it done. And there might be opportunity for that. Be diligent in the numbers you're running. Be confident in your numbers. Be confident and have confidence in that investment too. Have a vision. Those would be my advices for 2023. If you go by the numbers, if you have a vision, if you like the area, make sure that you know what your goals are with that investment. Some people look at cash flow only because they want to become financially free in a certain period of time. That's maybe a year or two or months from now. Some people look at flips. Some people, just look at tax benefits from it, because if you have a business that's not related to real estate, or even if you have a W-2 job, you can always deduct whatever losses you have in your rentals on your taxes. So you have to make sure that whatever strategy you use is benefiting you in some way, and that's where you find your criteria for buying. There's a lot of people that are investing because they have extra money, or are investing because they need the extra money. Whatever your case is, you have to define your buying criteria, and define the exit strategies that you're going to use for that property. What is the main one that you're going to use, and have at least one or two more exit strategies for that property you're buying. This year is going to be very interesting, I think. I think that the unexpected change in how the market was behaving is something that is exciting on one part, not so much on the other. I'm going to be honest with you, buying properties is much easier in a market that's correcting itself and that's having lower prices rather than higher. But at the same time, if you can count on appreciation and lower interest rates at a future point, then you're going to be good too, because you're going to be able to refinance and have your numbers work anyways. It's all about those tweaks that you can do in those numbers. Be really careful with the advice that you get, and make sure that you know how to do this. Make sure that you know how to comp. If you ask for a CMA, a comparative market analysis from a realtor, take a look at those comps. Ask questions about it. It's all about asking questions. Of course, the market is becoming more dynamic, and you're going to have to do this at a faster pace. It's not as quiet as it was before. That is the very last thing that I'm going to talk about, which is the speed that you have to act right now. If you want to put properties under contract, you need to be fast in doing all your due diligence. You shouldn't take longer than a day. And sometimes, if you see a property, start analyzing it from the moment that it gets to that you're aware of it. Even if it's on the market, let's say it's on the market as coming soon, and it's not going to be available for showings until a week from now, make sure that you analyze it without seeing it even. And we have seen things that went under contract without even hitting the market. And I'm talking about properties that are as coming soon on the MLS, and then they just go to pending because somebody offered a non-contingent offer. It's happening again, and we have to, as investors, we always have to shift with the market and make sure that we're doing what's right. Now, is there going to be such a big buyer pool as the prior years? I am not so sure about that. There are a couple of factors for it. One is that interest rates are not as low, so people that maybe were qualifying for buying a house, they're not going to qualify. So, but who knows? There are so many programs right now in Minnesota. There's one that's extremely good for buyers, especially first-time home buyers, are the ones that are going to benefit from this the most. There's the Minnesota Housing Program that I think it grants you like $18,000, or it really depends on your earnings, and you can possibly buy a house without even having any savings. So investing is gonna become challenging. It's gonna become really fast-paced, and you're gonna have to make decisions in a matter of hours sometimes. I don't want to scare you with that. I just want to prepare you. Because if you take too long anyways, when the numbers are correct and when the numbers fit, you should pull the trigger. Just make sure that whatever criteria you're looking for is very specific. So when you find that property, you pull the trigger right away, because that's what you're going to need to do this year. You're going to need to be fast. 2023 is going to be another fast year for investments, and you're going to have to know how to analyze all this. If you don't know how to analyze it, you can always contact us. All right, so that's all I have for you today. It's just me, so I don't know how much longer I can keep talking, really. With that being said, have a great week. We're doing a road trip to Florida, so we have a few long days of drivings ahead of us, but we're gonna enjoy the sun and getting out of the cold a little bit. Maybe we're gonna do some podcasts from there too. I hope you have a great week. See you next time. Thank you for listening to today's episode. We hope you enjoyed it and took some valuable information out of it. If you want to reach out to us with comments or questions, you can find us on Instagram, Facebook, and our website, milagrohomesre.com.